Imagine you own the biggest water park in the world. Every single pool, every slide, every lazy river, it all runs on one thing: water. If there's too much water, the park floods, rides break, people drown. If there's too little water, the slides dry up, nobody comes, the park dies. Now here's the thing, you don't control the weather, you don't control how many people show up, but you do control one thing: the pumps. That's the Federal Reserve. They run the pumps, and the water, that's money.
Let's build the park. The water park is the American economy. Every attraction is a different part of it. The lazy river, that's the bond market. Slow, steady, predictable, retirees love it. You put your money in, you float, you collect a little interest at the end. The wave pool, that's the stock market. Exciting, unpredictable. Sometimes the waves are fun, sometimes they slam you into the concrete. The big slides, those are banks. They take water from the top, deposits, and shoot it down to the bottom, loans. The faster the water flows through the slides, the more the economy moves. The kiddie pool, that's your savings account. Safe, shallow, barely any action. Your money just sits there doing almost nothing. And the food court, that's consumer spending. 70% of the entire park's revenue comes from people buying overpriced nachos and lemonade. If the food court closes, the park is finished.
Now, let's go underground. Beneath the park, there's a massive pump room. This is the Federal Reserve. 12 regional pumps, those are the 12 Federal Reserve banks, all connected to one master control panel in Washington. The person at the controls, that's the Fed chair. Right now, that's Jerome Powell. He doesn't own the park. He doesn't decide what rides to build. He has one job: keep the water at the right level. Too much water? He turns the pumps down. Too little water? He cranks them up. But here's the problem. He can't just look at the park and know. He has to read gauges, inflation gauges, employment gauges, GDP gauges. And those gauges, they're on a delay. By the time the gauge says flooding, the park is already underwater. The main lever on the control panel is called the federal funds rate. Think of it as water pressure. When the Fed sets a low interest rate, say near zero, that's maximum water pressure. Water blasts through every slide. Banks are lending like crazy. Mortgages are cheap. Car loans are cheap. Credit cards are flowing. People are spending. Businesses are hiring. The park is booming. But here's the catch. When there's too much water for too long, prices at the food court start going up. That lemonade that was $3, now it's $6. Those nachos, $12. That's inflation. The water didn't create more food. It just created more people with money chasing the same nachos. So the Fed does the opposite. They raise interest rates. They cut the water pressure. Now the slides slow down. Banks stop lending as much. Mortgages get expensive. Car payments go up. People stop spending. The food court drops prices to get customers back. Inflation comes down. But if they cut too hard, the slides dry up completely. People leave. Workers get fired. That's a recession. The park goes quiet. This is why the Fed talks about a soft landing. They're trying to turn the water pressure down just enough to stop the flooding without drying out the slides entirely. In 2008, the park almost shut down. The big slides, the banks, broke. They had been mixing clean water with contaminated water. Those were subprime mortgages. And when people realized the water was toxic, everyone ran for the exits. The Fed's normal lever wasn't enough. Interest rates were already at zero. Water pressure was maxed out. But the slides were still broken. So the Fed did something they'd never done before. They opened the floodgates. They went to the lazy river and started buying bonds directly. They printed trillions of dollars of new water and pumped it straight into the system. This is called quantitative easing, QE. Between 2008 and 2014, they pumped in over $3 trillion. Then COVID hit in 2020, and they pumped in another $5 trillion. The park came back to life. The slides started running. The food court reopened. But now there was a problem. There was so much water in the system that the park started flooding. Lumber prices doubled. Used cars cost more than new ones used to. Rent exploded. A dozen eggs cost $7. The water they pumped in to save the park? It was now drowning the food court. Starting in 2022, the Fed had to reverse course. They started quantitative tightening, QT. Think of this as draining the pools. Instead of buying bonds from the lazy river, they stopped reinvesting. They let the bonds mature and disappear. Water started leaving the system. At the same time, they jacked up the water pressure lever, interest rates, from near zero to over 5% in 18 months, the fastest pressure cut in 40 years. The slide slowed way down. Mortgages hit 7-8%. Tech companies started laying people off, banks started failing. Silicon Valley Bank was basically a slide that cracked from the pressure change. But the food court, prices started coming down, slowly, painfully slowly. Because once people get used to paying $6 for lemonade, the food court doesn't want to go back to $3. That's the thing about inflation. It's easy to flood the park. It's really hard to drain it without breaking something. So why should you care about the pump room? Because everything you do with money is connected to those pumps. When the Fed cuts rates, when they increase water pressure, your savings account pays you nothing. The kiddie pool is bone dry, but the slides are running fast. Stocks go up, houses go up. If you own assets, you're winning. If you don't, you're watching prices rise while your paycheck stays flat. When the Fed raises rates, when they cut the pressure, your savings account suddenly pays 5%. The kiddie pool is full, but the wave pool crashes. Stocks drop, houses stall. If you're trying to buy your first home, the mortgage payment just doubled. The Fed doesn't work for you. They work for the park. Their job is to keep the whole system running, not to make sure your slide is fun. So what do? You learn to read the gauges yourself. When the Fed says they're pausing, that means the water level is stable. Good time to plan. When they say cutting, water pressure is about to increase. Assets will pump. When they say hiking, slides are about to slow down. Protect your cash. The pumps are always running. The question is whether you're positioned at the top of the slide or standing in the flood zone. The Federal Reserve isn't some mysterious institution that only economists understand. It's a pump room. It controls the water. And every decision it makes, every rate hike, every rate cut, every round of QE or QT is just turning a dial. Now you know how the park works. The only question left is, where are you standing when the water level changes?